Investing. It might seem like a daunting word, something only financial experts deal with. But let me tell you, taking charge of your finances is empowering. It's about securing your future and achieving your dreams. That's where mutual funds and ETFs come in. Think of them as your gateway to the stock market. They offer a simple and accessible way to invest in a diversified portfolio of assets. Don't worry, we'll break down those terms soon enough. Whether you're just starting out or looking to diversify your portfolio, understanding these investment vehicles is crucial. So let's dive in. Together, we'll explore the world of mutual funds and ETFs, learn how they work, and discover which one might be the right fit for you. Ready to take control of your financial future? Let's get started. What exactly is a mutual fund? Imagine a big basket. This basket is filled with stocks or bonds from different companies. When you invest in a mutual fund, you're buying a piece of that basket. A fund manager chooses the stocks or bonds in the basket. Their goal is to grow the value of the fund over time. Mutual funds offer instant diversification. They spread your risk across multiple investments. This diversification is key to a balanced portfolio. It helps protect you from losses if one stock or bond performs poorly. Mutual funds are managed by professionals. This makes them a good option for hands-off investors. However, they do come with fees. We'll delve into those later. Now, let's talk about exchange-traded funds, or ETFs. ETFs are also baskets of investments. However, they trade on stock exchanges just like individual stocks. This means their prices fluctuate throughout the trading day. This is different from mutual funds, which are priced once a day. ETFs often track a particular index like the S&P 500. This means they aim to mirror the performance of that index. Like mutual funds, ETFs offer diversification. They allow you to invest in a variety of assets with a single purchase. They also tend to have lower fees than mutual funds. We'll explore their advantages and disadvantages in the sections to come. Mutual funds have long been a favorite among investors, and for good reason. They offer a blend of benefits that cater to both novice and seasoned investors alike. Let's explore some of their key benefits. Firstly, they offer diversification, which is a cornerstone of sound investing. By investing in a mutual fund, you're spreading your risk across a range of assets, including stocks, bonds, and other securities. This reduces the impact of any single investment performing poorly, thereby providing a more stable return over time. Secondly, mutual funds provide professional management. This means that your investments are being handled by experts. A fund manager makes investment decisions on your behalf, leveraging their expertise and experience to optimize returns. This can be a major advantage for those who lack the time or expertise to manage their own portfolios, allowing them to benefit from professional insights. Thirdly, mutual funds are accessible to a wide range of investors. You can start investing in mutual funds with a relatively small amount of money, making it easy for anyone to get started. This makes them an attractive option for new investors who are just beginning their investment journey and want to build their wealth gradually. Lastly, mutual funds offer liquidity, which is crucial for financial flexibility. This means you can easily buy and sell your shares at the net asset value, or NAV, at the end of each trading day, ensuring you have access to your money when you need it. This flexibility allows you to adjust your portfolio as needed, responding to market changes or personal financial goals with ease. Section 5. Mutual funds not without their drawbacks. While mutual funds offer numerous benefits, they also come with some drawbacks that you need to be aware of. One disadvantage is fees. Mutual funds charge fees for management and other expenses. These fees can eat into your returns over time. Another drawback is less control. When you invest in a mutual fund, you're entrusting your money to a fund manager. You have no say in the individual stocks or bonds they choose. Additionally, mutual funds can have tax implications. If the fund manager sells profitable investments within the fund, you may be liable for capital gains taxes, even if you haven't sold your shares. Finally, some mutual funds have minimum investment requirements. These can be quite high, making them inaccessible to some investors. Section 6. The allure of ETFs, advantages for savvy investors. Exchange-traded funds, or ETFs, have gained immense popularity in recent years, attracting investors with their unique advantages. One major advantage is lower fees. ETFs typically have lower expense ratios than mutual funds. This means you get to keep more of your investment returns. ETFs also offer tax efficiency. They are structured in a way that minimizes capital gains distributions, which can help you save on taxes. Moreover, ETFs provide flexibility. They trade on stock exchanges just like stocks. You can buy and sell them throughout the trading day. Lastly, ETFs offer transparency. You can easily track the holdings of an ETF. This allows you to see exactly what you're investing in. Section 7. ETFs, considerations before you dive in. While ETFs offer numerous advantages, it's crucial to be aware of their potential drawbacks before investing. Understanding these factors can help you make more informed decisions and avoid potential pitfalls. One consideration is trading costs. These costs can sometimes be overlooked, but can significantly impact your overall returns. Since ETFs trade on stock exchanges, you'll typically incur brokerage commissions when buying or selling them. These fees can vary depending on your broker and the frequency of your trades. These costs can add up, especially if you're trading frequently. Another factor to consider is liquidity, which can affect how easily you can enter or exit a position. While most ETFs are highly liquid, some niche ETFs may have lower trading volumes. This can make it challenging to buy or sell shares at desirable prices, potentially leading to higher costs or delays. It's important to research the liquidity of an ETF before investing. ETFs can also experience tracking errors. These errors occur when the ETF's performance deviates from the index it aims to replicate. This means their performance may deviate slightly from the index they track. Tracking errors can be influenced by factors such as management fees, trading costs, and the method used to replicate the index. Finally, it's important to note that ETFs, like any investment, carry market risk. This risk is inherent in all market-based investments and can lead to fluctuations in the value of your investment. Their value can fluctuate based on market conditions. Market volatility can impact the short-term performance of ETFs, but it's essential to focus on long-term investment goals. It's crucial to invest for the long term and ride out any short-term volatility. By understanding these considerations, you can better navigate the complexities of ETF investing and make more informed decisions. Section 8. Mutual funds versus ETFs, a head-to-head comparison. Now that we've explored the pros and cons of both mutual funds and ETFs, let's compare them head-to-head to help you make informed investment decisions. This comparison will cover several key aspects, including fees, trading flexibility, tax efficiency, control over investments, and minimum investment requirements. Fees. ETFs generally have lower expense ratios than mutual funds, making them more cost-effective over the long term. This means that the ongoing costs of managing ETFs are typically lower, which can significantly impact your overall returns, especially if you are investing for the long haul. Trading ETFs offer more flexibility, as they trade on stock exchanges throughout the day, while mutual funds are priced once a day. This intraday trading capability allows investors to react quickly to market changes, providing an advantage for those who prefer a more hands-on approach to managing their investments. Taxes. ETFs tend to be more tax efficient than mutual funds due to their structure and lower turnover rates. This tax efficiency can result in fewer capital gains distributions, which can be beneficial for investors looking to minimize their tax liabilities. Control mutual funds offer less control as a fund manager makes investment decisions, while ETFs provide more transparency and control over your holdings. With ETFs, you can see the exact composition of your portfolio at any given time, allowing for more informed decision-making. Minimum investments. Mutual funds often have higher minimum investment requirements than ETFs. This can be a barrier for new or smaller investors who may not have a large amount of capital to start with. ETFs, on the other hand, can be purchased in smaller quantities, making them more accessible. Ultimately, the best choice for you depends on your individual investment goals, risk tolerance, and preferences. Whether you prioritize lower costs, trading flexibility, tax efficiency, control over your investments, or lower minimum investments. Understanding these differences can help you make a more informed decision that aligns with your financial objectives. Section 9. Real-world investing, putting your money to work. Let's bring this to life with some real-world examples. Imagine you're a young professional just starting to invest. You want a diversified portfolio but don't have a lot of money to invest. An ETF that tracks the S&P 500 could be a great option. It allows you to invest in 500 of the largest US companies with a single purchase. Now, let's say you're approaching retirement and looking for income. A mutual fund that invests in dividend-paying stocks could be suitable. These are just a couple of examples, and the possibilities are endless. Section 10, your journey to financial wellness, embracing mutual funds and ETFs. Congratulations! You've taken a significant step toward financial empowerment by understanding mutual funds and ETFs. Remember, investing is a journey, not a race. Start small, diversify your investments, and don't be afraid to seek guidance from a financial advisor. The most important thing is to start investing early and consistently. Whether you choose mutual funds, ETFs, or a combination of both, remember that knowledge is power. By understanding these investment vehicles, you're taking control of your financial future. Now go out there and make your money work for you.